Warren Buffett has a huge cash problem. His holding company, Berkshire Hathaway, it has $149 billion in cash and short-term investments. In our low interest rate world, this is earning little to nothing, but it gets even worse. With the recent increases in inflation, the real returns on cash and most short-term investments are negative. Heck, the 10-year Treasury yield, it comes in close to only 1.5%, while recent annualized inflation numbers are well above 5%. So investors can lock into a 10-year risk-free note and they're getting negative real returns. It's a crazy world that we live in. With massive amounts of stimulus that have really propped up assets across the board, we're seeing anomalies, big deviations from long-term historical averages. This is important for investors like you and me. It really pays to watch and see what the world's best investors are doing to manage their own money around these trends. In this video, there are a few key takeaways, and to start, we're going to take a quick look at Warren Buffett's cash problem. And also, if you find any of this research useful, I'd really appreciate it if you just tap that like button down below, as well as subscribe for more, because that really helps out my channel. So here's the chart of Berkshire Hathaway's cash and short-term investments. Since 2010, Warren Buffett's cash pile has climbed from below $400 billion to over $149 billion today. It's up close to 300%. Warren Buffett, he's really struggling to find worthwhile investments. And there are really two main reasons why. Up first, part of this is due to size constraints. There are some accounting and reporting rules that factor into this as well. Berkshire is a much larger company than it used to be. On top of its huge cash pile, the company's market cap comes in at over $600 billion. So targeting $1 billion, $2 billion, and even $10 billion companies, it doesn't make as much sense as it used to. To really move the needle, Berkshire has to focus on $50 billion or $100 billion plus companies. So Warren Buffett, he's fishing in a pond with fewer fish. Sure, they are a lot bigger fish, but most of them are not worth their weight today. And that brings me to my second point, that the stock market is overvalued. Since 2010, the stock market is up more than 300%, but total company earnings have not grown nearly as fast. As a result, stocks look expensive based on many metrics. So here's a chart with the popular S&P 500 PE ratio. The chart goes back over a century. You can see that the recent PE ratio far outpaces long-term averages. It was only higher around the dot-com and housing bubbles. And when it comes to long-term stock market returns, the PE ratio has been a pretty useful indicator. I did a breakdown on the correlation between PE ratio and then the forward 10-year stock market returns. Now that video, it's one of my earlier ones, but it still has useful insight today, so I'll link to it down in the description below. Many other metrics are showing an overvalued stock market as well. I've covered many of them here on my channel. One of Warren Buffett's favorites is total stock market cap to GDP. It's climbed higher than even the dot-com and 2008 bubbles. It's just much harder to find good buying opportunities today. Most stocks look very overvalued. So with these lofty valuations and fewer viable stocks to pick from, it's no wonder that Warren Buffett's cash pile, it's really climbed. Although there is a time-tested strategy to this approach, but nonetheless, it hasn't stopped the naysayers. Some people have said that Warren Buffett is losing his magic touch, and some of that criticism makes a little sense. Berkshire Hathaway actually underperformed for 5, 10, and even a 15-year stretch. Although recently that's turned around a bit, and even during that time of underperformance, I wouldn't bet against this legendary investor. He's a tried and true value investor. Sure, he's missed out on some huge opportunities, but that's a part of the investing game. Luckily, it's not 1, 2, 3 strikes and you're out. Instead, you can just keep on waiting for the best pitch for easy home runs. Now, doing nothing, it really isn't easy, but waiting for great deals has paid off big time over the long run. If you invested just $1,000 into Berkshire Hathaway in 1965, it would have climbed to over $28 million today. To compare against average stock market returns, the red line in this chart shows the S&P 500, and it looks flat. Investing $1,000 into the S&P 500 over that same time frame would have grown close to $250,000. Not too shabby, but it really pales in comparison, and I think anyone would prefer the $28 million instead. So Warren Buffett, he has gone through plenty of periods of underperformance. When stock valuation growth outpaces underlying cash flow growth, he tends to pump the brakes, and cash builds up and it weighs down returns. And this is kind of a warning to investors that the market is frothy, along with many other valuation metrics. It's hard to find worthwhile investments, value investments, although this is really what helps set him apart. When a market downturn hits, he has all that cash ready to go. He can then pick up beaten down investments when they trade out cheap valuations. One of his many bits of wisdom, which you've probably heard, be fearful when others are greedy, and greedy when others are fearful. That's really easy to say and also keep in mind, but it's really hard to put into practice. On top of that, going against the crowd, it doesn't always work. Nonetheless, you do have to go against the crowd if you want at least a chance at beating average returns. If you've made it this far, thanks a lot for sticking around. And once again, I'd really appreciate it if you just tap the like button down below. You might be interested in this video as well. And that other research on the price to earnings ratio and stock market returns, I've linked to that in the description below.